Okay, this video is going to be on chapter 15 related to distributions to shareholders, dividends, and share repurchases. So back in the back of the chapter, we want to understand what happens if the company has a stock split. So we have Gamma Medical stock trades at $90 a share, and they are contemplating a 3-for-2 stock split. So if you had 2 shares of stock, after that stock split, you would then have 3. So assuming it'll have no effect on the market value of that equity, compute the stock price after the stock split. So again, we have a 3-for-2. And then it's currently at $90 a share. Yes. Okay. So then they don't really give us any share amounts. So you're a potential shareholder, but we don't know how many you have. So let's just assume you have 2. So if you had 2 shares at $90 a share, you'd have a $180 investment. If then the stock split happens, then all of a sudden you have 3 shares. But the key to it is the market value doesn't change. So this is still the dollar value of my investment. So then now what does change is the market price per share. So now I have 3 shares. So then the market price, to get this to work mathematically, would have to go down to $60 per share. So that $60 per share is going to be my new market price. So again, I kind of had to back into that just to get the mathematics to work, but that's what you want to be able to do. And that's really why companies go through stock splits, because they want to bring their stock price down. So it's a way for them to bring the stock price down, which hopefully will make their stock more marketable. Okay. Then we have another one that deals with stock repurchases, which again can happen. Companies can choose to buy back shares of their stock. So we have Beta Industries has a net income of $2 million. And it has 1 million shares of common stock outstanding. The company's current stock trades at $32 a share. The company is considering a plan which will use the available cash to repurchase 20% of the shares that in the open market. So they're currently outstanding, held by investors. They're going to go out and buy them back if they can. The repurchase is expected to have no impact on net income or its stock price. So then what is going to be their earnings per share? So if they currently have 1 million shares outstanding, and then they currently have $2 million of net income. They don't really ask us to do this, but for comparison's sake, I will. If we calculate their current earnings per share, it's going to be the $2 million of net income divided by the 1 million shares outstanding. So that would be $2 per share is their earnings per share. Now, if they go through and they're able to buy back, it says that they want to buy back 20% of the shares in the open market. So then now, if they buy back 20 shares, or I'm sorry, 20,000 shares would be the 20% of the market. 200,000. 200,000 would be 20%. That would leave them 800,000 shares outstanding. So if their net income didn't change, if they still had $2 million of net income and they had 800,000 shares, if I can get that decimal right, 800,000. So then now if we take that $2 million and we divide it by our 800,000 shares, that gives us $2.50 per share. So then you can kind of just see numerically that if a company wants to raise its earnings per share number, obviously as an investor, what you would hope that they do is actually increase their net income. Generally, if their net income goes up, that would also increase their earnings per share, and that's really what you're hoping for. But they could achieve that same increase by buying back shares of their stock. So then now they're reducing the number of shareholders outstanding, so there's less people sharing the income, which brings up that earnings per share number. Okay, then the third thing that you have in this chapter is calculating out dividends and how companies decide how much to pay out and when to pay out. So we have Bulls Sporting Incorporated is prepared to report the following income statement. So they give us an income statement. We've got net income of this is in thousands, but so we'll just leave it. It's 1,800. So that would really be 1.8 million, but we'll leave it in the smaller increments. So the net income is $1,800. And then they tell us that they have 500,000 shares of common stock outstanding, and the stock trades at $48 a share. If they had paid out a 40% dividend payout ratio in 2014, and they want to maintain that same payout ratio, what would be the per share dividend? So what I like to do, I mean, again, you could do this a couple different ways, but what I like to do is calculate my earnings per share first. So my earnings per share is going to be the net income of and in this case I am going to take it out all the way, 1,800,000. And then if I divide that net income by the 500,000 shares, that's how I calculate my earnings per share, so I'll figure that out. So 1,800,000 divided by 500,000 gives us $3.60. So that's my earnings per share. Now, they'll really never pay that out in dividends because, again, that's their total earnings. But if we now say, okay, they want to pay out a 40% dividend payout ratio. So then all we're going to do is multiply that. So $3.60 times 0.4 gives us $1.44 as our dividend. So if they were paying out that 40% ratio, that's what it would be. Okay, then it says, if we look back at 2014, the net income in 2014 was $1,500,000. And if the number of shares remained constant, if it was 500,000 shares, then what was their per share dividend in 2014? So then the income was a little less. The shares outstanding were the same, but then that would give us an earnings per share of $3. If they paid out 40% of that, then they would have paid out $1.20 dividend. Okay, then it says, okay, so instead of saying that we're going to pay out the same percentage, the same 40%, what if we decide to pay out the same amount? So we're going to say, okay, in 2015, we're going to pay out the $1.20. So if that were the case, if they paid out the same dollar amount, what would the payout ratio be? So then we go back to say, okay, well, if our earnings per share is $3.60, what do I multiply that by to get to $1.20? So again, using our algebra solving skills, if we take that $1.20 and we divide it by the $3.60, it gives us 0.333, or 33.33% would be our payout ratio. So they're just kind of considering different options. They could stay at the 40%, which would make them pay out a little bit higher of a dollar amount of dividend, or they could keep it at the $1.20 and then pay out a little bit less of a percent. Then it says, assume if they're considering dramatically expanding their operations and it will require significant amounts of capital. If they had that type of a scenario and they didn't really want to issue new common stock equity, then which way should they go? Then of course they should pay out the smaller amount of dividend because it would leave them more cash to finance their capital projects. And then there's actually one other computation in this chapter that I inadvertently skipped over. So we'll come back to it now, and that's dealing with our residual dividend model. So the residual dividend model it's kind of like how we ended that one that we touched on, that the companies may choose to take the money that they have left over in their retained earnings or what from their net income from last year and invest it in projects instead of paying any dividends out. So the residual dividend model would say that the company would be better off using all available cash to finance the equity needs of their projects instead of issuing new shares of common stock, and then only pay dividends if there's money left over. So with this particular company, this Axel Telecommunications has a target capital structure of 60% debt to 30% equity. The company anticipates that its capital budget for the upcoming year is going to be $3 million. If Axel reports net income of $2 million and it follows that residual dividend payout policy, what will their dividend payout ratio be? Okay, so we've got a capital budget of $3 million. So that's how much